Hi, this week we have 3 interesting webinars lined up for you. First one is on top biases you should fight. This webinar is happening at 10 a.m. At 12 p.m. we have navigating the cement business. We have another webinar at 12 p.m. which is using MS for asset allocation. All the registration links for the webinar are given in the description below. Do register. Thanks.
Delivering experience versus delivering returns. Wherever an investor deals with a professional manager, what is he looking at? Most of the time, I see that investors are only looking at what returns were delivered. Rarely do investors actually value what experience they got in the process. As long as the returns are good, investors are happy. But when return starts going down, investors start becoming unhappy. How do investors manage to stay invested during difficult phases when the returns don't look as lucrative as an investor would like? Every investment manager will go through these phases when returns don't look attractive and when it appears that the investment manager is not performing as well as he has done in the past. Such phases happen to every professional manager. But what should a professional manager do during those phases? That's the most important thing for an investor to understand and to assess. As an investor and as my own manager, what would I do? I'm wearing both hats, investor, manager. I ask myself as a manager, what I should do in my investing that will once again start delivering performance over the long term. That's one. The second thing is, I ask myself, what can I do differently now in line with the emerging market context? How can I do something different which will eventually deliver performance? The third thing I ask myself is, what is it that I should avoid doing now? And why should I avoid it? The next thing is, where should I position my portfolio's risk? Should I raise it? Should I lower it? Or should I just maintain the risk as is? All these questions eventually translate into only one thing. It translates into an ownership experience in my portfolio for me as an investor, which gives me comfort, confidence, and peace of mind. I'm just going to let things happen after I do all the changes that I think the portfolio really needs. And then I decide what are the incremental actions I need to take in my portfolio and just let those actions be taken. And once they're taken, I let them play out to their own time frame. No anxiety. If I can deliver myself an investment experience that gives me all these things, returns would follow. So, there is no need for me to become too anxious about my returns when they are not looking great. There is no reason for me to change my conviction in my investing when returns go down. All I need to do is tweak my investing to align with the market context and to stay ahead of the emerging market scenario so that when the market once again starts delivering superior performance, my portfolio will be ready to capture that performance. So, when I improve my investment experience, especially during a difficult phase in the market, I prepare myself to deliver returns to my own portfolio. So there is a sequence which we follow as investors, and it is the same sequence that we would like to follow as managers. So for instance, there was a 4-5 month phase in solitaire where I found that our strategy was not mirroring the market. So market saw banks, especially private banks, leading it. We were not invested in private banks. We were lagging. But we were not keeping quiet. We were continuously giving calls to our investors to contribute cash, to participate more. Investors were contributing cash and continuously participating. The money contributed by the investor was going into specific stocks, which we believed had the capability to do better than the benchmark and which could drive the portfolio to a better place even without the portfolio owning banks. So it involved 3-4 months of focused activity, incremental work, subtle tweaks, scaling up of specific bets where we were convinced that the portfolio could be driven by that stock, scaling up of individual positions in a very gentle and rehearsed manner so that we prepare the position and ensure we have a decent position size in stocks which could deliver superior portfolio performance. All these things happened over a period of 3 months. Subsequently, when the portfolio started performing again, it was because of all the activity that we did in these 3 months. Remember, we were not chasing returns at the time. There was no point. We were lagging. And we could not buy banks. So there's no point chasing near-term returns. But we were changing the portfolio gently and repositioning the portfolio for a time when investment performance would show up because stocks started performing better in their businesses in the last quarter. Now, this was a conscious activity we did. And we could do this only because both the investor and the manager, which is us, were able to stay on the same page and focus on improving our experience and eventually delivering superior returns by improving what we were doing during the difficult phases that the portfolio was going through. Every investor, whether he is his own portfolio manager or he is working with another portfolio manager, needs to understand this and needs to improve his experience and deliver better investment experience to himself, build more confidence in his investing and in his portfolio, contribute capital to his portfolio when returns are not looking great, and eventually, by doing all of these, ensure that he delivers returns with a far superior investment experience when the markets come back to good health. This has happened to us several times in solitaire, and I am sure it will happen many more times in our work. And this confidence comes from my own experience as an investor, because in every market cycle this has happened to me. And with every market cycle, I have grown my own conviction in my portfolios and the strength and robustness of my process by which I invest more money when markets are looking difficult and conviction is running low all around me. I have shown more conviction when markets did not show conviction, and by virtue of that I was able to deliver superior returns. This applies whether I am investing for myself or for all of you. There is no difference, because investing is not about just delivering returns. It is about doing a lot of things that improve our investment experience in difficult times, and every little thing that we do in difficult times eventually ends up delivering superior returns. As long as we understand this, we would be delivering experience and delivering returns to every investor's portfolio, and our own portfolios will do extremely well over the long term. Thank you for watching this video.